Guys, good morning. Pratheesh here. So today, what we're trying to do is that we're trying to show you an indicator which we are using in our community for execution of your trades. So as you all know that we used to get a contextual view of the market. Market context is understood via 30-minute time frame using volume profile or market profile charts. And the same execution is done via 5 minutes chart. So 5 and 30 minutes combo is what actually we use for trading futures or options, whatever we try to do. Right. So 30 minutes, we take the overall market context and the execution was done in 5 minutes. So the major question arises is where to buy, where to sell, where to put a stop loss, etc., etc. So to avoid this confusion, we have developed our own in-house indicator, which can be plotted the trading view charts, so that it will give you a proper buy and sell signals. Based on that, you can take a trades and put your stop loss as suggested by the indicator. This indicator is developed based on the condition that even a small dip or a pullback will not hit your stop loss and go in the direction of your view. Say like you have a long bias, so you took a trade and you put a stop loss. What happened now? Market comes, hits your stop loss and goes in the direction of the long. So you get frustrated and you think that okay, the markets are being manipulated and they are coming to hit your stop losses and etc., etc. Okay, so to avoid all these confusions, you have developed an indicator that in such a way that shallow pullbacks are not getting affected when you're in a trade. But this complete reversal is likely to happen only whenever your stop loss will get. Otherwise, shallow dips or pullbacks may not hit your stop loss, and there is an option for you to trail your stop loss as per the market movement. Okay, so that is how we are trying to use this indicator, and this indicator is mainly on a trading view platform. So I just apply this indicator on my Nifty futures chart. So this is a Nifty futures chart, and this is the last trading days data that we have on the chart, and you can see here. Along with that, we use this volume chart. VPA volumes we'll be using on the trading view default indicator. VPA volumes are there. So just to see what price, okay, comparatively volumes are there or not, etc., etc. For that we use that. But the whole purpose is based on our indicator. So here, this indicator will give you positional short and long signals. Indicates that the markets are weak on the higher time frame. Indicates that it's a positional short. So like we have got a positional short long back somewhere around here. We got a positional short, and still the markets are in positional short. So whereas we got a positional long somewhere around here and the extreme fag end of the market, and after that market came down and went it sideways, and later there was a reversal. Markets started coming down. So kind of a trend following approach, right? So in trend following, most probably there could be small stop losses hitting every time here and there, and there could be a big winning trade that is likely to happen. So that kind of winning trade is this. So if you have taken the signal somewhere around your positional long at the fag end of the rally, then probably could have reversed your position based on getting a short signal, and there you could have lost significant amount of points, and then now the trend is very clear that it is going into positional short. So still there is no reversal signal coming in the market. So for that purpose, you can use this positional long and short as a kind of a stop and reverse kind of mechanism. Got it? And now we have this buy and sell signals plotted on the chart. You can see here, you're getting a buy signal here, you're getting a sell signal here, you're getting a sell signal here. So all these signals are generated based on the candlesticks pattern. So these signals are random in nature, so that based on the candle patterns, you will get these buy or sell signals. So our idea is that we have to use this buy and sell signals at the respective places. Say like markets are at support, then you can use this buy signal. You're supposed to use this buy signals to take a trades. Similarly, markets are at resistance, then you can use the sell signals to take sell trades. Don't use it in the opposite direction. Say like markets are at the buy, markets are at the resistance, you don't take a buy signal. You avoid that kind of signals. When markets are at resistance, you look for only sell signals. Markets are at support, you look for only buy signals. So that is where the confusion gets solved, which signal to take at what point of time. So horizontal supports and resistance is what I mean actually. You can use any method to find out the support and resistance. People use classical technical analysis like horizontal supports and resistance. Some people use volume profile levels and they have the support and resistance marked on the chart. So whatever way you use, that doesn't matter. But whatever support or resistance that you have identified in the chart, when market comes to that level and you gives an appropriate signal, say like market comes to your resistance, gives you a sell signal, go and take a trade. Similarly, market comes back to your support zone, it gives you a buy signal, go and take a trade. Okay, in that way, the confusion gets cleared. Right? This all is only for intraday purposes. And when markets directions are similar in the sense, intraday, already the markets are positional short. So already you know that markets are in a positional short for a very long period of time. So in that case, if you want to trade in the direction of the sell side, then it will be more profitable because both the directions are aligned together. The intraday is also on the sell side as well as positional is also on the sell side. So the probability of the market going on the downside is much higher than that of going on the upside, because higher time frame is always on the sell side. Okay, you're trading in the direction of the higher time frame on a lower time frame. Got it? Now you're having another few more indications in the chart is what we call as the background signals, background shades. You have three different background shades here. One is green, another is red, another is neutral color. So green indicates that the intraday momentum. So we are using this on a 5-minute chart. So green indicates that the intraday momentum is on the buy side. Okay, intraday momentum is on the buy side, and red indicates that the intraday momentum is on the sell side. And this neutral color indicates that the pressure has reduced. In the sense, either it could be a buying pressure or it could be a selling pressure. So here the markets are in a sell side. Now it turns into neutral from the sell. So the selling pressure is slightly reduced. So after that, what would happen is that it can give a fresh momentum buy or a fresh momentum sell. As of now, the selling pressure is slightly reduced. That's all what you can see from this chart. Then again, the selling pressure started to come. Then again, it went into neutral. Then again, a selling pressure. Then selling pressure continues. In between, you have some neutral bars. And finally, market closed with a selling pressure in the market. So this is all with respect to Nifty futures chart. The same thing you can apply to any futures chart. It could be Nifty, Bank Nifty, it could be any instrument, okay? Futures chart, any stocks, etc., etc. You can apply that. And similarly, you have a, what do you say? Stop loss indicator is also there. You can have this buy stop loss. Okay, you can have the sell stop loss. So like you feel that, okay, markets are at the resistance and you took a short trade over here, then this is your stop loss. You took a short trade over here, this is your stop loss. So when you get a fresh sell signals, your stop loss is going to be trailed automatically as per this indicator. Say like you have taken a short trade over here, probably it could give you very good points by the end of the day. So last minute there was a big move actually, because why the stop loss gets hit? Because the market moved from the lower extreme, that is a 23,574 to all the way to 95 points. 100 points move happened within a 5 to 10 minutes. That is why your stop loss got hit at this point of time. Otherwise, there is no option for the stop loss to get hit. Okay, so hide these levels. So similarly, if you have taken a short trade here, okay, I'm not telling you that once you use this indicator, every trade is going to be a profitable one. Okay, there could be a loss-making trade also, but you have to manage your risk accordingly. So say here, the same indicator you have applied and you have taken a sell signal over here. Assume that your markets are in short and you took a sell signal over here and your stop loss is here. So on this pullback, what happens now? The market hit your stop loss because the pullback was not a shallow pullback, it was a sharper pullback. Okay, 745, it went all the way to 985. So your stop loss got hit on this process, and you're waiting for the next signal. Next signal in the sense, markets are in sell side hold. Positional is short. Intraday is also short. Only the thing is that you're getting a selling pressure is reduced over here. Then you're getting a pullback short over here. You can take a short rates on this pullback short, or a follow through sell signals after this pullback short. You're getting a follow through sell signal of this pullback short. You can take a trade. Okay, so you can use buy stop loss as well as your sell stop loss, etc. As and when you take a trade. Okay, other all parameters are there. 1.5 AB, 2 AB market profile levels are there. If you want, you can use that. The EMAs are there. If you want, you can use that. And all these indications are there. So these are all additional indications that if you want, you can explore it, or else you keep it in a basic settings over here. These are basic settings where we try to trade the direction of the markets. Okay, it's not a holy grail that every trade is going to make money. but it is an objective way for you to enter an exit trade, where you can manage your risk more effectively than randomly trading somewhere around here. So like markets are short, you take a sell trade here, you keep a stop loss above this candle high. Then once market comes down again, you will trail your stop loss somewhere around here. On this pullback, it would have hit. So instead of doing that kind of random stuff, if you use this indicator, it will give you where to enter, where to put a stop loss, and whenever there is an opportunity given by the market to trail your stop loss as per the market movements, then you can trail it. So it's a better way of execution of our trades, so that your risk can be managed effectively. So like you take 5K risk for a trade, that can be managed effectively because you're not going to put a random stop losses at each and every bar high or something like that. Okay, it's a kind of a structural stop loss, which most of the time will not hit on a contra pullbacks until and unless the pullbacks are very sharp. So like this is what happened here. Okay, 100 points more, something like that means it will definitely hit. But otherwise, shallow pullbacks, etc., you're being safe and you're in the direction of the trade. Got it? So this is how that indicator is applied. It can be applied to any chart. Okay, any futures instrument you can apply this. The same thing, we have developed another indicator which is especially for options. Here also, options also same indications. And another thing is that with respect to an options trading, what personally people do is that everybody is into the selling the straddles. Right? When OTD was very popular, people are selling straddles with predefined stop losses, okay, time-based entries, etc. But what we have done is that instead of going and taking a trade based on time-based, okay, what you have defined is, what you have found out that with respect to the market direction, if you're able to spot and sell a straddle, that will be more advantage for you rather than plotting it on a time-based or with a random stop losses. Okay, so for that, what I've done is that we have developed a straddle dashboard, which will tell you that which straddle is in sell or which straddle is in buy, and what you can do with that. Okay, so this is your straddle dashboard. I'll enable the straddle dashboard. So instead of looking at each and every straddle, whether it is a buy or sell signal, we can simply put it on the Nifty chart, because we are trading Nifty. We are looking at the market direction based on the futures chart. Okay, at the same time, we should be also able to identify which straddle is giving a sell signal, so that we can go and take a trade on that particular straddle, so that it gives you more points. When you are right, it gives you more points rather than entering at a different random times. Okay, so here you can see the LTP of the straddle will be displayed. So the straddle, you can just click this indicator and you can go to this input. You can enter your symbols over here. At this point of time, 10 symbols are there. You can use the straddle symbol over here. I have plotted from 24,000 to 23,200. I have plotted the symbols. You can plot any straddle of your choice over here. So normally what we do is that we'll take an ATM straddle as a reference, and then from there we'll have 4 or 5 straddles on top of ATM or below ATM. So in that way you can plot it, or any straddle of your choice you can plot. 5 or 10 straddles you can plot over here. Now we have another, and you can customize this. You can keep this at anywhere in the chart. Okay, say like I can keep it in the middle right, I can keep. So wherever it is comfortable, you can keep that. So now coming back to this particular thing, you can see here you have a positional indicator, intraday indicator, and a pullback scenario. So here what happens now on an intraday basis. So first, normally what happens now, whenever ATM straddle is always in a sell mode. ATM straddle will be always in a sell mode. Okay, at sometimes the straddle may spike. Okay, due to so many reasons, there could be a spike in the volatility index. So due to some reasons, what happens now, the straddle may be in the buy side at some point of time. But every time, most of the time, okay, but most of the time, straddles are always in sell mode. That is, that ATM straddle will be always in the sell side. Sometimes what happens, due to some unusual behavior or some events are approaching, due to the spike in the VIX, the straddle may be not in the sell side. It could be in the buy side. So for that, how to identify is that we have an intraday column over here. So the extremes marked here are -100 and +100. We have marked the extremes over here. minus 100 and plus 100. Okay. So whenever any straddle gives you a value of minus 100 and beyond, minus 120, minus 130, etc., etc., anything below minus 100, it indicates that the straddle is in the sell side. Okay. Similarly, any straddle on an intraday, if it tells you that it is above plus 100 or beyond that, plus 120, plus 130, 150, 200, 230, whatever it is in the buy side. From this table, you can see that 23,900 straddle is at 101. That means 23,900 straddle is a buy straddle and you are not supposed to sell this straddle. Okay. And the same concept is applied to the positional also, because whatever change that happens on intraday will be slowly reflected into positional. Because as you told that we are operating in two different time frames. One is your 5 minutes and 30 minutes. So 30 minutes will be a higher time frame and 5 minutes will be a lower time frame. So the changes that happens in 5 minutes will be slowly reflected in 30 minutes. Okay, whatever change happens in 5 minutes will not be immediately reflected in 30 minutes. It will take some time for the market to reflect the changes that happens on the lower time frame to higher time frame. So the weakness continuously, the weakness is there or the strength is there. Slowly that gets migrated to other higher time frames. So first change that what you notice is on an intraday column. Later on, the straddle will turn into positional. Now we can see 23,700, 600, 500, 400, 300, 200. All these straddles are with positional short. You can see 2400 straddle is positional buy. That means you are not supposed to sell straddles beyond 23,700 because 23,700 from 23,200 it is a sell side. So this is a sell side. Now, how can you sell these straddles, or where is the best price to sell these straddles? So the best price to sell these straddles is very simple. You have called a pullback columns are there. So you come to know that okay, the market, the positional shorts are active on these particular straddles. Means the value in the positional column is less than minus 100. Okay, below minus 100. So these are all red, minus 107, 128, etc. These are all. So the idea is that the values are below minus 100. At the same time, the pullback column values will go to plus 135. So this is right now 85, 55, 77. Some values are there. At times, okay, the straddle will be in a sell mode, but suddenly you will get a pullback, the straddle chart. And when that pullback happens, this column will turn it into plus 135 levels. 135. So whenever this column gives you an indication of plus 135 and above, at the same time, positional shorts are active. Positional shorts in the sense the value should be minus 100. So this column will show you positional shorts are active. At the same time, plus 135 should be reached on this particular pullback column. Whenever that is happening, probably you can go and take a short on that straddle with a defined stop loss. Predefined stop loss in the sense the stop loss that we follow on expiry day is 38%. Okay, on a non-expiry day it is a 10%, because on expiry day premiums will be very cheap. Okay, so we use 38% stop loss for such premiums, and for a non-expiry day the premiums will be slightly higher, so that we could use a 10% stop loss. So this is the stop loss categorization for intraday, expiry, intra-expiry, and non-expiry days. Got it? So this is how it is being done. Now let us compare a particular Nifty chart as well as a straddle chart. Okay, so you need to understand that how to find direction using straddles. So that is the most toughest question everybody has. How to use this dashboard effectively, or how to find the direction of the market using the straddle charts. Okay, the direction of the market is very simple. Say like markets are trying to go down. Okay, markets are trying to go down or markets are trying to go up, whatever way. So the markets are trying to go down, then towards that direction, say like markets are at 23,890 or 900 levels, you feel that okay, markets are going towards 23,700, 800 levels. You look at that 23,700 or 800 straddle. That straddles will start to give you a sell signal. So like when markets are at 24 at some higher levels, the straddle may not be in a sell side. As the market started to proceed towards that straddle price, straddle levels from 23,900, the markets are trying to go towards 23,700. Then probably 23,700 straddle will give you a signs of sell signal. So like the value of 23,700 straddle may be plus 100 at some point of time. After some point of time, markets are trading, coming down and going towards 23,700. At this point of time, what happens? The 23,700 straddle value from plus 100 suddenly drops. Okay, from plus 100 it drops to 98, 97, and slowly it turns into minus. Okay, then finally it goes below minus 100. It indicates that okay, markets are now comfortably going towards 23,700. Okay. Now there is an exit signal for these trades. So normally what you do, as I told you, out of stop losses are there. 38% stop loss on a non-expiry, on an expiry day, and 10% stop loss on a non-expiry day. Okay. Another one more thing we focus here is that, say like you get a sell signal on a straddle. On an intraday basis, you're getting a sell signal. Okay, intraday basis, you're getting a sell signal. You're selling a straddle with stop loss. At some point of time, what happens? Stop loss may not be getting hit first, but before that, there could be some significant changes that happens in the dashboard. What will happen is that, so like this is minus 100. Assume that this is minus 100. You sell this straddle. Suddenly, what happens? There could be a pullback. So the value starts to increase. That it is in the positive side. So like it will from minus 100 it will go to minus 90, minus 80, minus 70, minus 60, etc., etc. It will go to positive value, such that whenever any straddle from the sell side or below minus 100 goes above plus 60, okay, goes above plus 60, then probably you have to be very careful that this particular straddle is going to buy mode. What happens is, what I'm telling is that minus 100. Sorry, cannot write here. Okay. Minus 100 is sell. Okay. 100 is buy. Whatever column you are getting, whether it is an intraday or positional. Positional means you are comfortable in carry forwarding that particular strategy for the next day. Not you focus only on intraday. So in both cases, below minus 100 is sell and above plus 100 is buy. When this plus 100 is active on a positional basis and on the pullback column, you are getting plus 135. It is a pullback short. Okay. Similarly, plus 100 is on the positional column. You get minus 135 on the pullback column. Then it is a positional long, pullback long. And another case is exit is that you are getting a minus 100 on any intraday straddle. You are selling the straddle with a proper stop loss. Stop loss, as I told you, 38% is for expiry day. 10% is for non-expiry days. Non-expiry days. I'll show you all these indications on the straddle chart. Okay. Wait for a minute. 100. So assume that you put the stop losses. And now either the stop loss will get hit or the market will go in your favor and the straddle will become zero on an intraday. Okay, either stop loss will get or the straddle will go to zero. This is one exit mechanism by putting a stop loss. Another exit mechanism is that before the stop loss gets hit, you will get a warning signal. Warning signal in the sense, say like you sold a straddle with minus 100 levels. So what happens is after some time you put a stop loss. After some time the value goes to say like minus 80. Actually, the straddle value should go beyond minus 100, minus 100, 120, etc. It indicates the sell side momentum is very strong on the particular direction. But instead of that, the sell side momentum is getting reduced. It goes to minus 80, minus 70. At one point of time, it goes above plus 60. Plus 60. So plus 60 is the warning sign that if you are short in any of the straddles, you need to exit. Because plus 60 is a threshold level. Beyond that, you could not hold any straddle which you are short. Okay, either you get a warning plus 60 first. After that, your stop loss may get hit, or else your stop loss will get hit and then you will get a warning signal. So whichever signal first comes, you act accordingly. Sometimes before your stop loss hits, you get a warning signal so that you can exit that straddle and look for a fresh straddle which is giving a value of -100. This straddle is going into buy side in the sense some of the straddle will be going into sell side because the market direction might have been changed. So look for other straddles which is giving a -100. Got it? So this is how we take trades accordingly. Got it? Now let us go to this. Is that straddle charts? Here is the straddle chart. This is what is the straddle? This is a 23,500 straddle over here. I'll put it comparatively. I can show you this. Okay, this is the Nifty futures chart. We'll parallelly compare what happens here. This is the Nifty. We'll keep it on the top right. Okay, this is the Nifty chart. What happens is here, the market opens, right? So let us go to the market opening. The market opens at around 23,994 or like the first candle close was at around 23,950 somewhere around. So let us go and plot a 23,950 straddle. So double click this. You can just plot this as 23,950. Here also 23,950. So this is 23,950 straddle. But the market starting. Let me keep this straddle chart here. Okay, you can see here, this is the straddle. This is the same indicator that we applied on the straddle chart. The same indicator, what you get it on the futures chart, the same momentum, everything will be applied on the straddle chart also. You can see here, the straddle is already in the buy mode. In the previous session somewhere around 220, etc., the straddle went into a buy side momentum. Positionally, it was short because you're getting a pullback short signal. Positionally, the straddle was short, but intraday, due to some spike in the VIX or sudden activity in the markets, could have brought the straddle into a buy side momentum. So on an intraday basis, this is on a buy side momentum. But positionally, it is on a short signal. So even if you are trading positionally, then you can use this pullback short signal to take a trade, and then from that entry, you have to put a 38% stop loss if you're trading expiry day. And if you're trading non-expiry day, then you can use a 10% stop loss. Select, I just click this stop loss, select, you get a pullback short here, and you're taking a short trade over here, somewhere around here or here, you're taking a short trade. And this is assumed to be a non-expiry day. So basically, you're going to give a 10% stop loss somewhere around here. Percentage or something like that. 10%. The expiry day, you're going to give a 38% bigger stop loss. Here, the stop loss is hit because the markets are in the buy side momentum. Momentum is on the buy side. So whenever you're taking a pullback short signal, even though the stop loss may hit, because straddles are in a spiky mode because momentum is very strong on the straddle side, buy side. So when such things are happening, you don't want to take any short trade on the straddle. Now you can see here straddle, the buying pressure or buying momentum slowly fades down. And then suddenly it is again coming up. Okay, then finally what happens at some point of time at around 11 o'clock, somewhere around here, 10:30, 11 o'clock, the straddle started to give a sell signal. That is, the background color changes, sell side. Continuously, the straddle is going down, down, down. Then after some time at around 12:10, that is somewhere around here, 12:10. What happens now? 12:10, the next candle, what happens? The selling pressure is started in the Nifty futures. At the same time, here the selling pressure on the straddle is slowly reduced, and the straddle started to make these kind of higher bottoms. So you can put it in the line chart. You can see here the straddle is making a higher bottom. That means the markets are going to go down. Why? Because the straddle is going up. Straddle is going up in the sense 23,950 puts are likely to spike higher than the magnitude of the calls which is getting reduced. So straddles are spiking. So now we can see here. Now what happens at some point of time, the selling pressure gradually reduced, and at around 140. So this candle, I think 1240, now 140. 140, the straddle again went into a buy mode. Right? So at this point of time, say like market opens and the selling pressure has reduced at some point of time, somewhere around here, if you want to short a straddle, select 23,900 straddle. 23,900 and 23,800 straddle. Select, we go and take a 23,800 straddle. Feel that, okay, markets are going to go down, then you are supposed to sell 23,800 straddle. Very simple that this is a directional straddle. You expect the market to come down towards 23,800. So you sell a straddle when the market is at 23,900. So like somewhere around in the 10:35 in the morning. 10:35 in the morning. See this. Straddle has gone into sell. Around 10:40. Around 10:40, straddle has gone into sell. It indicates that market is moving towards 23,800. Now positionally, the straddle is short. Now intraday also, the straddle is coming into short. You are getting a short signal, short background over here. The momentum is on the sell side. So what you are doing, you are selling the straddle at somewhere around here. Once the candle closes, the background gets confirmed. So the next candle opening, you are taking a trade somewhere around 420. And this is a non-expiry day. So you're supposed to keep a stop loss of 10%. Okay, something like 10%. So your stop loss is at this level, 463, and your entry is somewhere at around your entry is somewhere around here. So this is an confirmation, and now taking entry somewhere around here. 21 and 463 is your. Now the straddle is coming down. Straddle is coming down. Now you calculate the risk here. So risk is 40 points. Risk on your trade, right? So as soon as the market makes 40 points, you trail your stop loss. So now here you are making 42 points. It's coming over here. So you sold here, right? You sold here. It's at this level, you are making 72 points. So you are supposed to trail your stop loss based on that 1:1 kind of risk reward scenario. Trail your stop loss accordingly. So from 421, you would have made somewhere around 350. So 50, 70 points you have made on this straddle. Now look at this 23,600 straddle. It has given a shot. 23,600 straddle. Look at this green move happened this straddle. This straddle initially at around 9:45, this particular candle, when this candle was forming, 9:45 market closed at around 23,900 or 890 somewhere around. Whereas this straddle 23,600 was in sell mode. You would have sold this straddle somewhere around here. Okay, if you have sold this straddle somewhere around here, and your stop loss is what I told you, 10%. Somewhere around here. So obviously you could have some stop losses somewhere around here, 548, and your entry could be somewhere around here. So almost 50 points SL. We are taking a trade, and then slowly market momentum dropped. So from 500 all the way to 350. Okay. So you have made a big run in the straddles. Closing, you're making 130 points on the straddle. It's a clean indication that which straddle is in the sell mode. Obviously, the straddle dashboard. So in the straddle dashboard, you could have got a sell -100. So when the market's at this level, if you have plotted 23,600 straddle is in your dashboard, the straddle should have given you immediately a sell signal at around this particular opening candle. Opening candle, so 23,600 straddle will give you a sell signal, but normally what you do know, we will not focus on that first 5-minute bar. First 5-minute bar, we leave it as it is. We will focus on only on the second 5-minute bar. So the second 5-minute bar itself is giving you a sell signal. So you can take a trade here at around 500 and put a 10% stop loss. You would have put a 10% stop loss. In this case, the stop loss would have hit. Okay, stop loss would have hit. Again, the same condition. Every trade is not going to make you money, right? So, but the process itself is a great thing to monitor. The straddle goes into buy, and then by around 9:45 candle close. By around 9:45 candle close, if you have this dashboard with you, and you would have got a -100 signal minus 100 here on an intraday column when this particular candle closes. So once that particular candle closes, you would have taken a trade here, put a stop loss of around 10%, somewhere very close to it, like that, 10%. Sometimes it might have hit, and sometimes I think if you have survived this stop loss move, then probably you would have made a good amount of points. And say like if your stop loss is getting hit, nothing wrong here, nothing wrong here. You could have, sorry, this. We are having this pullback short signals over here also. So whenever you are getting this pullback short signals, you can trade. Or else when the momentum shifts down the sell side, again you can take a re-entry. Again you can take it, because in straddle signals we don't use on buy and sell signals, because these are not actual proper bars. Most of the candles will be a doji candle only over here. Okay, either you can use a line chart. Whenever the background turns red, you can sell it with a proper stop loss. So even if this stop loss gets triggered, you would have entered a trade somewhere around here with a 10% stop loss, and that could have given you a very good clean points. So this is how we sell directional straddles based on the dashboard. So we know that which straddle is on a sell side. At that point of time, if you see any other straddles, the straddles are not continuously going down. Got it? So this is how we look at the dashboard and see that, okay, whichever straddles are in sell, and is there any opportunity to capitalize on that straddle? Is there an opportunity to capitalize on that straddle? Got it? So this is how we take trades on the straddles. So if your direction is good enough, then you can sell a directional straddle. Like I don't want to sell a directional straddle, then wait for the ATM straddle to go into minus 100, then you can sell that ATM straddle. Put a stop loss. So either the stop loss will get hit, or you will make money on the straddle, or else the straddle will give you an exit signal. So you sell a straddle at the 23,900 straddle when market's at 23,900. Okay. From here, what will happen is that the 23,900 straddle market will go sideways. The 23,900 straddle will decay, and it will make you money. You put a stop loss. Sometimes what happens, the market suddenly moves towards any extreme, so that the stop loss may hit, or else before the stop loss getting hit, you will get a warning signal from the dashboard. Say like the straddle value is above plus 60. That means you have to exit from the straddle. So whenever you get a warning signal, you exit from the straddle even before the stop loss hits. Okay, then look at an ATM straddle. If it is giving a sell signal, you go and take a trade. Sometimes if the markets are really directional move in the sense coupled with the spike in the volatility index, when both compo signals are being triggered, you suppose at that point of time ATM straddle will not be in sell signal. That is the case when ATM straddle is not in a sell signal. It is the time to buy options, because ATM straddle most of the time it will be in a sell side. If that is not in the sell side, then probably there is something wrong with the markets. So you're not supposed to sell straddles at that point of time, because selling straddles is an unlimited risky trade, even though you use stop loss, etc. But hedging is the proper method, so that even if something happens in the market, you will lose only whatever you are taken risk in the initial case. Your risk is defined. You ask me, I put a stop loss. Fine, you're putting a stop loss, but what happens if the stop loss gets skipped? There is always a possibility of something going very bad in the markets. Okay, so better idea is to do with some hedges, or else do reduce to size with stop losses, so that even if stop loss gets skipped also, you can go and manually exit at some point where the loss may not be that much high, because your quantity is very small. Okay, if you're trading a bigger size, then probably you could buy some edges, even though if you use manual stop losses, etc. But you should buy some edges. And if the ATM straddle is not in a position to sell, then it is better to buy options, because selling straddles is not going to work anymore. So you have to shift it into the buy side trade. If you are getting any directional bias based on the buy side, then go and take a buy side trades. Got it? So this is how we use these indicators for our day-to-day purpose. Straddle dashboard will be always there. So at any point of time, I can see which straddle is in sell and which straddle is in buy. And if I get a direction that, okay, on this particular day, market breaks the day low, After some sideways consolidation, markets breaks the day low. So 23,800 is gone. So I feel that, okay, if 23,800 is taken out, then the next destination could be 23,600. So I could sell a 23,600 straddle instead of selling a 23,800 straddle. You can even sell 23,800 straddle, but I have a view that, okay, 23,800 is taken out. Now the next destination is 23,600. This is my view. It may be right or it may be wrong. That doesn't matter here. But at this point of time, my view is that, okay, if this low is being taken out, next support is at around 23,600. So when this low is broken, I would rather trade 23,600 straddle instead of 23,800 straddle. So look at this low is broken on this particular candle at around 1250. You look at this candle, 1250, 50 somewhere around here. Would have traded this short straddle over here. 430. From 430, it have made around 350. Some 30, 70, 50, 70 points I would have captured over here instead of taking a 23,800 straddle. So like if you have taken a 23,800 straddle, what would have happened? It would not be smooth. At time when you are taking a trade, it is 23,800. Later on, markets are coming down, and that 23,800 is not anymore an ATM straddle. Okay, it's getting into a directional straddle. 1250, what is the case? 1245 is the selling pressure is reduced over here. So you are taking a trade over here at around 375. It made a low of around 350. 20 points is done, and then the straddle started spiking higher. Why? Because the markets are coming down. So it's not an ATM straddle at that point of time. So probably your stop loss might be get hit, or you may not make any money on this particular straddle. Got it? At some point of time before this buy momentum is triggered, you would have got any exit indication in the straddle. You would have exited the straddle and you would have got to another ATM straddle. So the idea is that whenever you have a directional view, you can sell a straddle based on the directional view. Select my directional view was select 23,800 is being taken out, and now 23,600 is the target. I look at the 23,600 straddle for any sell signals. Okay, then I go and take a trade. Similarly, if a day high is taken out, okay, if the day high is being taken out, my bias is that, okay, the day high is being taken out, my bias is like 23,200 or 300, it will go. So I'll go and look at the 24,300 straddle in the dashboard. So if it is giving me a good sell signal, then probably I'll go and take a trade. Because the opportunity is very, very limited time. The opportunity will be there only for a limited time to get at very good prices. If you miss that opportunity, then probably you'll not get the price again. So it's better to use these indicators, which will guide you to sell which straddle at which point of time based on your view in the markets. So this is your directional straddle. Most probably we are using directional straddles. We will deploy a straddle first, then based on the market direction, we'll move the straddle towards the market direction so that we could capitalize more on the down move or up move. Okay, basically the direction move we are trying to capture via positioning our straddles in the direction of the market. Got it? So that is how we made money by deploying directional straddles. So for all these things, you can access these indicators. Okay, and right now we have been using these indicators only for our community. And if you are interested in getting these indicators, then you can ping me in the Discord or WhatsApp or Telegram, whatever it is. You would be given access, and it could be on a subscription basis. Okay, very small subscription charges are there, and you can use these indicators, and you will get support of when you are facing any difficulty with the indicators. Always you can communicate with me. You will get a real-time support also how to clarify your doubts. So with that, I'm coming to an end of the session. We are closing this session for the day. Thank you guys. Have a nice day.